Hey there. What if you could identify the exact suburbs primed for explosive growth before the rest of the market catches up? Today, we're revealing 21 untapped growth pockets across Australia's major capital cities, backed by hard data, infrastructure analysis, and demographic trends. By the end of this video, you'll know exactly where to look and what signals to watch out for. So let's dive in. So we'll break down 4 critical data points that separate tomorrow's winners from today's overpriced suburbs. And stick around because later I'll reveal the single most important metric that predicted every major suburb boom over the last decade and how you can start using it today. So look, welcome back to the channel where data-driven property investors get the edge. They need to build serious wealth. And I'm here to cut through the noise, ignore the headlines, and show you exactly where the smart money is positioning right now for capital growth in 2026 and beyond. So here's the reality. The traditional property hotspots, they're already priced in. The growth has already happened. If you're buying where everyone else is buying, you're paying a premium for yesterday's news. But if you can identify the untapped pockets, the suburbs with the right fundamentals before they hit mainstream awareness, that's where generational wealth is built. Today, I'm pulling back the curtain on proprietary suburb analysis. We've crushed the numbers on infrastructure spend, population growth, demographic shifts, and rental market dynamics across every major city in Australia. And what we found are 21 specific suburbs that are sitting on the edge of serious capital appreciation. This isn't guesswork, this is data. Let's get into it. So, Australia's property market in 2026 is at a critical inflection point. Interest rates are stabilizing, migration is at record levels, and billions of dollars in infrastructure projects are reshaping our cities. But here's what most investors miss. The market doesn't move uniformly. While inner city blue chip suburbs see modest gains, fringe and middle ring suburbs with the right catalysts can deliver double-digit growth. According to the latest national data, Australia's rental vacancy rate sits at just 1.2%. That's historically tight. Capital cities like Perth are at 0.7%, Adelaide 0.8%, Brisbane 1%. These are supply crisis levels, guys. When rental markets tighten, capital values soon follow. But vacancy alone doesn't tell the full story. You need to layer in infrastructure investment, population inflow, and demographic transformation. When all 4 factors align, you get what we call a growth convergence event. And right now, we've identified 21 suburbs across Sydney, Melbourne, Brisbane, and Adelaide where this convergence is happening. So let's break down the framework. Infrastructure spend is the single most predictive indicator of future capital growth. Our analysis shows suburbs within 5 kilometers of major transport, health, or education projects consistently outperform comparable suburbs by 8 to 13% over a 3-year period. So let's start with Sydney. The Western Sydney International Airport opens in 2026. This is a 37 million passenger per year facility running 28,000 direct and indirect jobs by 2031. The metro line connecting St. Mary's to the airport is an $11 billion project. That's right, with a B. And the suburbs along this corridor are still undervalued. Marsden Park, median price currently around $750,000. The suburb sits directly on the metro corridor between Tullabong and the new airport. Infrastructure upgrades include the Townsend Road expansion, new schools, and commercial precincts. Our analysis shows this suburb has infrastructure investment per capita 3 times the Sydney average. Vacancy rates there, under 1%. Rental yield, 4.6%. Right. Leppington, Western Sydney Growth Precinct. The train station opened in 2023. Since then, median prices have surged 50% annually. Current median there, $820,000. The population growth, 4.1% per annum. Dwelling approvals, they are lagging at 2.3%. That's a supply-demand imbalance, screaming future growth. Now, looking at Melbourne, the suburban rail loop is a $125 billion project. SRL East, Suburban Rail Loop East, connecting Cheltenham to Box Hill, begins tunneling in 2026 with completion by 2035. This project is acquiring hundreds of properties and reshaping Melbourne's middle suburbs. So Box Hill, the epicenter of the SRL East, an underground station with 6 new platforms, direct CBD connections, and a new master plan approving high-density housing towers. Median dwelling price here is currently $1,100,000. Seems pretty expensive, but here's the key. Box Hill is still below neighboring suburbs like Glen Waverley at $1,400,000, and the gap is closing. Our data shows Box Hill will re-rate by 10 to 12% within 18 months of tunneling commencement. Next, Cranbourne West's outer southeast growth corridor. This benefits from the SRL via the Cranbourne station upgrades. The median house price here is $650,000. Population growth, 3.8%. We've got new school approvals, road upgrades, and shopping expansion all flagged for this location. And the rental yield here is still 4% with a vacancy rate of 1.3%. So looking further into Brisbane, we've got the Cross River Rail, which opened key sections in 2025. This 5.9 kilometre tunnel with 4 underground stations is transforming Brisbane's north and south. So looking closer into Redcliffe, which is located in the Moreton Bay region, which is 35 kilometres north of Brisbane CBD, has coastal lifestyle, upgrade rail links, and affordability are driving demand absolutely mad out there. So the median house price is $900,000. That's actually up 11.2% in the last 12 months. 5 years ago, this suburb was $450,000, which is a 98% increase. But compared to inner Brisbane, which has just crossed the $1 million median mark, Redcliffe still offers value. The vacancy rate is 0.9% with a rental yield of 4.3%. Infrastructure drives everything. So follow the government spend, follow the transport upgrades. That's where the growth begins. So the second critical data point is the population to dwelling supply ratio. When population growth significantly outpaces new housing construction, you get upward pressure on both rents and prices. Simple supply and demand. Our analysis of ABN or Australian Bureau of Statistics data shows the sweet spots. Suburbs with population growth above 3.5% per annum and dwelling approval growth below 2.5%. This creates a structural shortage that takes years to correct. And prices, they adjust rapidly. So looking at, for example, Sunbury in Melbourne, outer northwest, which is 40 kilometers from the CBD, the population growth here is 4.2% annually. The dwelling approvals has only been 1.8%, and the current median, being $670,000, is a prime position for investment. Infrastructure here includes a new train station upgrades and road expansions. Vacancy rate is 1.4%. This is textbook supply and demand mismatch. Looking towards Brisbane in North Lakes, this is the northern corridor. Population is 4%, with dwelling approvals at just 2.1%, and the median price at $710,000. Again, the area is attracting young families and professionals seeking space and affordability. Rental yield is 4.5% for investors. Looking back at Melbourne, Wallet, 26 kilometres north of the CBD, this is one of Melbourne's fastest growing suburbs. New housing estates, parks, schools. The median price is still affordable at $590,000. Population growth here has been 4.3%, with dwelling approvals struggling to keep pace at 2.4%. This suburb is a volume growth play. Right? Affordable entry, high tenant demand, strong future upside. Perth is also experiencing a similar dynamic. After years of stagnation, Perth's population is surging due to interstate migration and mining sector growth. Vacancy rates are the lowest the nation has ever seen at 0.7%. Baldivis, one of the suburbs here, which is in the outer southern growth corridor, the median price here is $540,000, with a population growth of 3.9%. New estates, schools, shopping centres popping up. The rental yield, 4.8%, one of the highest in metropolitan Perth. Our data shows Baldivis has appreciated 9% in the last 12 months, but it's still 30% below the Perth median. Significant catch-up potential here for this suburb. When you see population flooding in faster than homes can be built, that's your signal. Get in early, lock in equity before the market rebalances. The third factor is demographic shift. Not all population growth is equal. What matters is who is moving in. When median household income rises by 15% or more over 3 years, combined with an influx of residents aged 25 to 44, you're witnessing suburb gentrification. And gentrification drives premium pricing. Our census analysis reveals this pattern very clearly. Looking at Clayton South in Melbourne, this is a middle ring suburb 20 kilometers east of the CBD. Median household income has increased 17% in the last 3 years. 25 to 44 age group now represents 42% of residents, which is up 31%. Why? Proximity to Monash University, upgraded train services, and new commercial developments. The median price here at $850,000 with an annual growth rate of 9%. This suburb is transforming from the industrial commercial to lifestyle professional. Banyo in Brisbane, north of Brisbane, 10 kilometers from the CBD. The demographic shifts driven by young professionals and families mainly. The median income has gone up by 16%. The median price is $730,000. Rental yield, 4.2%. New cafes, schools, parks, signaling lifestyle upgrade. Our data shows Banyo is in the early phase of gentrification, and it's still affordable, but appreciation is accelerating. Then back to Melbourne, looking at Preston, inner north suburb, undergoing rapid transformation. We've got gentrification around Bell Station, new developments, boutique, retail, cafe culture. Median income is up 14%. The median price, $920,000. This benefits from proximity to the CBD with strong transport links and a creative professional demographic influx. The growth potential is 8 to 10% annually for the next 3 years. Even Adelaide is seeing this pattern. Elizabeth Vale, for example, in the northern Adelaide fringe. Traditionally, this is working class suburb, now experiencing real demographic renewal. The median income is up 12%, with new families moving in seeking affordability. The median price, $490,000, with a rental yield of 4.8%. The vacancy rate, 0.8%. This is high yield, high growth territory for investors willing to back transformation suburbs. Track the demographics, when educated, higher income residents move in, councils invest more, amenities improve, and prices follow shortly. The fourth and final factor, rental market dynamics. Low vacancy plus high yield equals strong investor demand and capital growth runway. So our threshold, which is vacancy below 1.5% and a gross rental yield above 4.2%. That is our threshold. So let's run the numbers. So Perth is leading the nation. Suburbs like Callaroo, northern coastal suburb, median price is $700,000 with a rental yield of 4.6%. Vacancy rate here, 0.7%. You've got coastal lifestyle, proximity to Hillary's Boat Harbour, and the under construction Ocean Reef Marina. This suburb offers scarcity-driven growth, limited land, and high with strong demand. Also in Perth, Leaderville, which is an inner city gentrification hotspot. The median price here is $650,000 with a rental yield at 4.4%. Vacancy rate, 0.9%. You have cafe culture, walkability, young professional demographic. This is a classic inner ring play with capital growth and cash flow. Brisbane's western suburbs also show similar signals, such as Redback Plains, which is in Brisbane's western growth corridor. Right, the median price here, $590,000 with a rental yield, 4.7%. Vacancy rates, 1%. Infrastructure spending is exceeding $1.5 billion in transport and health, with a population growth of 4%. This suburb ticks every box. And the Adelaide's fringe also continues to tighten. Tea Tree Gully in the northern corridor. Median price, $610,000. Rental yield, 4.5%. Vacancy rate, 0.8%. New housing estates, schools, and amenity upgrades with a growth trajectory of 7 to 9% annually. So when you see tight vacancy and strong yields, institutional investors and cashed-up occupiers aren't far behind. That's your window. Act before the herd arrives. So look, earlier I promised to reveal the single most predictive metric, and here it is, the growth convergence score. This is our proprietary algorithm combining all 4 factors: infrastructure proximity, population dwelling imbalance, demographic income shift, and rental tightness into a single ranking. Suburbs scoring above 85 out of 100 have historically delivered double-digit capital growth within 24 months. Right now, we've identified 21 suburbs across Australia scoring about 85. You've heard most of them today: Marsden Park, Leppington, Box Hill, Cranbourne West, Redcliffe, Northern Lakes, Sunbury, Walla, Baldivis, more from this video. But there are 5 more we're tracking very closely for members only. Suburbs on the cusp of major announcements, rezoning, or infrastructure unlocks. This score is updated monthly. It's how our members stay ahead. So if you found this data-driven breakdown really valuable, do me a favor, hit the like button, subscribe to this channel, and drop a comment with the suburb you're watching. I read every comment, and we'll analyze your top requests in upcoming videos. This is the kind of analysis that separates winning investors from the crowd, and you're part of that winning cohort now. Now, if you're serious about leveraging this intel, here's your next step. Join our exclusive membership community. You'll get access to our full growth conversion score database, updated monthly suburb reports, detailed infrastructure tracking, and live monthly strategy sessions where we break down emerging opportunities before they hit the market. We also provide one-on-one portfolio reviews and suburb-specific acquisition strategies. This isn't generic advice. It's tailored, data-backed, and designed to accelerate your equity growth. The link is in the description. Book your call today, and let's build your property wealth strategically and intelligently. Thanks.